Welcome to Going Long with FCLT Global, the podcast that dives into the world of long-term investing and strategic decision-making, hosted by Sarah Williamson. Going Long features thought-provoking conversations with some of the brightest minds in finance, economics, and business today. Each episode will bring you exclusive interviews with renowned executives, investors, and experts who are driving change in the world of finance, getting their unique perspectives and uncovering strategies that have shaped their success. Whether you're an investor, a business leader, or simply curious about the forces shaping our global economy, join us as we explore the power of long-term thinking. This is Going Long with FCLT Global.
Thank you for joining us for the Going Long podcast. Today, our guest is Ashby Monk, the Executive and Research Director of the Stanford Research Initiative on Long-Term Investing, which conducts research to help institutional investors better achieve their long-term goals. Ashby's had more than 20 years of experience studying and advising investment organizations. He's authored 7 books and published numerous research papers on institutional investing. And his latest book, The Technologized Investor, won the 2021 Silver Medal from the Axiom Business Book Awards. Outside of academia, he's co-founded several companies that apply advanced analytics to drive better investment decision-making. So Ashby, thank you very much for joining me today.
Hi, it's fabulous to be here. I read all of your papers and books at the FCLT, so it's fun to get a chance to have a chat with you about all that work as well.
Well, we obviously share a deep interest and a passion in long-term investing and the role that long-term investors can play in driving prosperity. I liked your quote you put somewhere, which was long-term investors quite literally put the capital in capitalism. I think that's a great way to put it.
That's right.
And so your institute is trying to analyze and understand and augment the investment decisions of these long-term investors. Can you describe it a little bit in more detail and tell us what you're working on and why is it in the engineering school and not the business school and all those sorts of things? So give us a little background on the institute.
Oh, you're not the first one to ask me why I'm not in a business school, but I'll bury that lead for, a minute or two from now and say, first and foremost, I think our existence, in part, is very, very similar to your existence. I can remember when FCLT got started. I can't remember which of the kind of 3 organizations said this, whether it was McKinsey, CPPIB, or BlackRock. But there was a statement at the time, I think it might have been Mr. Wiseman, who said, the pension funds ultimately are kind of the base layer of this capitalist system. And so if you actually want to change corporate behavior and you want to help corporations become long-term, you have to follow that chain of intermediaries back to the base set of incentives. And I really believe that. That was like a very powerful comment for me to kind of validate the work I had been doing at Stanford, which was to say, gosh, if we can improve pension funds or sovereign funds or endowments or insurance companies, we should be able to change the incentives and their managers, and that should have knock-on effects down into the portfolio companies. So that's the same mission I have, which is to empower these organizations to help themselves, which is another way of saying generate higher risk-adjusted returns and secure their promises. But the sneaky part, I guess, or the part that's kind of the additionality here is, well, we're trying to help them help themselves. We want to have them help the world. There's infinite investment opportunities out there, especially as you start thinking about space, outer space as an investment topic. But in all sincerity, there's endless opportunities. And so a lot of our work is about, hey, can we solve climate change? Can we fund infrastructure? Can we build new healthcare systems through this long-term capital while helping them generate high performance? And I can tell you about the engineering school if you like.
Please
Are you
do.
ready for it? Okay.
I'm very interested to hear that. And then we're going to come back to investing in outer space.
We can't miss the space investment thesis. But first and foremost about the engineering school, let me just run you through this idea, which is to say, what are asset owners? Got about $140 trillion in these organizations around the world, depending on your definition. But these asset owners Are they businesses? Well, if you want to work for CalPERS or CalSTRS, generally you have to sit for a civil society, civil service exam. You're working in a unionized government job. And if you go ask somebody that works for a public pension plan, do you feel like you're working for a business? Many will say, are you crazy? They're generally optimizing for stakeholder interests rather than shareholder interests. They have a sponsor that has a unique set of constraints and needs, whether it's sitting inside a university like our endowment at Stanford, or it's a sovereign fund sitting inside a central bank like in Norway. These organizations don't look and feel like businesses. Now, we design these organizations also to be arm's length and sometimes double arm's length from government. So there again, it's difficult to say, oh, you should be in a school of government running this work. Are they not for profits? Well, no, these organizations are seeking profit. Maybe their returns are not taxed by the tax authorities because we see these organizations as societally critical, but they are seeking to maximize profit. So we don't really have a good name for these organizations. So in part, I'm in the engineering school because the big important engineering projects of the day require this capital. And so my mission is to think about, hey, where are we going to get the $271 trillion that Munich Re says we need to avoid the worst consequences of climate change? Big sentence there. But also because we don't have schools of investment. We don't actually have programs of study focused on this community of asset owners. I think I teach the first class in the world to undergraduates on why pension funds exist, why sovereign funds exist, how they use capital markets to achieve their goals. And so I'm in the engineering school in part because where else would I go? It's a multidisciplinary, multi-method environment where I can think deep thoughts about industries and work with industries to solve big problems.
Okay, well, that makes perfect sense to me. And I do
Oh my
think
gosh, that's amazing. It made sense.
it actually does. And I think that I find that these asset owners, broadly speaking, whether they're pensions or sovereigns or endowments or whatever they are, really are misunderstood, and they are often under the radar. They don't necessarily want to be in the headlines, and they're not advertising for customers, or they don't need to be out there. And oftentimes, people in the markets don't quite understand who they are or where they are. So I see why you're thinking of it that way.
Can I riff with you on that for a second and just
please.
say, every time I would teach a class at Stanford, I would ask my students, how many of you have the dream to go work at a pension fund? And you can imagine that over the course of 14 years that I've been at Stanford, I would love to say I had zero, but I did have one student raise their hand in 14 years. And it was in part because that student had already been working at the National Pension Service in Korea and was doing a master's degree and thought he might like to go back. But students just don't know about this space. If you're an undergrad or even a graduate and you want to be an investor, your pathway is to shuffle off to Wall Street, do an investment banking program, hope you get a private equity job or some other job, sit down and, take a CFA. We don't have a pathway. And so in part, like part of my mission in life, and that mission evolves over time, is to make, the millions of students out there aware that there are these amazing organizations where you can pursue investment careers and still feel like you have this incredible positive mission behind you, which I know because I teach a lot of young people right now. They want that mission. They want to feel like they're giving back to their communities. So I know I'm rambling now, Sarah.
No,
but
that's good. When you said you had one person raise their hand, I was going to ask if that student was American, but you just told me that.
No, he was Korean.
Yeah, I think that's the other thing is that especially, there are some countries where their sovereign wealth fund is well known, obviously, in the country, or their pension plans are well known and well respected in their own countries. In the United States, obviously we don't have a sovereign wealth fund per se. There are some states have some, I know, but pension plans aren't usually in the recruiting office at the university. So that's the truth. So, yeah, tell us about this. You've got this fellowship to go.
I do.
CalPERS. So while we're on the track of, how do you get talent excited about understanding what's out there and excited about it, tell us about this fellowship that you've got going.
Well, I want to create that new pipeline from the most talented environments where maybe it's universities like Princeton, Harvard, Stanford, Yale. I want to create a pipeline from those ecosystems to long-term investors, and that bypasses the traditional managers, okay, where there's a different DNA. There's a shareholder primacy. There's a bunch of different incentives that exist inside a for-profit manager that don't exist inside a long-term investor like the kind I think you and I are focused on. Or at least I know you have other organizations as part of FCLT, but really our mission at Stanford is to focus on these asset owners. And so we wanted to build a new pipeline. And I had spent, this was my second year teaching a class called Institutional Investors and Sustainable Capitalism. And the feedback, which was really fabulous, also said, how do I get a job at these places? Like I've just learned over the course of a quarter at Stanford, the universe of asset owners. I didn't know this universe even existed. In many of their minds, the world of finance is Wall Street, it's venture capital, it's hedge funds. They don't even know where the money comes from. So then we kind of do the matrix on them. We give them I think it's the red pill, maybe it's the blue pill, I forget. We give them one of the pills, it opens their mind. And then they say, but how do I go get a job there? And then I turn around and say, I don't know, actually. I don't know. There is no pipeline. And so I got together with Nicole Musico when she was still at CalPERS. And we said, hey, could we build a pipeline that starts with CalPERS, but goes beyond CalPERS? And so the vision I have for this thing is that it's like a Teach for America, that we are going to build a pipeline to place top graduates from universities at a whole series of public pension plans, in part to bring that really talented youth inside pension plans. And maybe that mixes things up a little bit and gives them an opportunity to innovate or challenge existing ideas. But my sneaky ambition, which maybe is no longer sneaky because I'm saying it on your big famous podcast, is that I want this generation of young Americans, and some of these folks are just studying in America, they're actually from overseas. I want them to be aware of the unique experience of working at a pension fund or a sovereign fund or a permanent fund. I want them to have that sense. You were saying, we don't have sovereign funds here in America. And that's true, but we invented the sovereign fund and the Texas Permanent School Fund. We literally invented it here. But do you think students know that? That the first sovereign fund in the world was set up in 1854 by Texas? It was a land grant fund dealing with the subsoil assets that we know as, Texas crude. We want these students to be aware, and they're not students actually when they become fellows. They're students when we hire them, and then they go off. And we've just selected our first 4. They're fabulous. They're going to CalPERS the second week of September. They'll be at Stanford for the first week of September. And they're going to be seconded on rotation at CalPERS for a year. And then ideally, they will come back to Stanford and they will help to mentor the next cohort. And the dream is that we're not just sending 4 to CalPERS, we're sending 4 to CalPERS, we're sending 2 to Massachusetts, we're sending 2 to Texas, we're sending 2 to Wisconsin, and that we build this program in the way that Teach for America was built, and we really help young Americans learn about this ecosystem that I think you and I are so passionate about.
That's really exciting. Well, I'm super enthusiastic about that, and we'll see how we can help.
Please help. We need help. I'm a one-man band out here. I read 100 applications by myself. It's and these people are delightful. That one of the interesting conclusions was how many of the cover letters said, I had no idea this was even an opportunity until your fellowship came around. Undergrads, they're like, wait, I can do a fellowship that's elite, They love to get the status. You know what I mean? And so then all of a sudden, everybody started digging in to understand this space, and the cover letters read like a realization. Oh my gosh, I've had this epiphany. That's what they all read like. Anyway.
Well, that's the first thing, is just to make people aware that it's out there. That's
exactly.
Right. Well, it's going to be really interesting to see what they think of it, what the CalPERS people think about it, what you learn from it as you go through. I'm sure there's going to be a lot of learning. We'll have to talk about that in a year after you've heard back from them.
Yep.
But you said a few minutes ago, what do you have to do? You have to take a civil service exam. You have to do all of these things. So one of the challenges, as you well know, of these institutions is, as we think about sort of what drives long-term behavior, we think a lot about governance. We think a lot about metrics. We think a lot about incentives. And the governance in some of these institutions and the incentives in some of them are not always super clear. Like you said, it's not just beat a benchmark or return money to shareholders. It's broader than that and more complicated. So how do we get the right incentives in these organizations that lead to mission-oriented people wanting to do their best job, rather than people getting lost in the politics or the bureaucracy of a particular state or organization?
Yeah, we have a lot of work to do on this one. And it starts with transparently revealing the cost of producing investment returns, which I admit is a mouthful. But right now, if you went to the average long-term investor and said, help me understand the cost of producing all of this, internal, external. I know that some of you are going to call the carry you're paying private equity a profit share. Stop it. It's not a profit share. It's your money. You're paying them fees. Let's unravel all of that together and begin to unravel the cost of producing the performance that we need to produce in order to pay these social benefits. These are social organizations. They receive tax breaks from the IRS. So I think it's fair to say, hey, we have decided to accumulate wealth in these funds. We've given them tax breaks. Let's unravel, given that we're choosing as a society to compound this capital, to understand the cost. Once you can unravel the cost, then you can start to say things like, well, where are we seeing alignment of interest? Where are we seeing the best bang for our buck? If you go back to the Canadian model, they realized through their Crown Corporation governance structure, they could actually run a cost-benefit analysis like this, where they said, where are we getting the best bang for our buck? Should we invest in internal talent, or should we continue to invest in external talent? And clearly they tilted in favor of the internal talent model. And in part, I remember when I was working for a big Canadian pension plan around 2012, the logic was you could get the same performance as an external manager at 1/10 the cost. And so they were doing it all day. And so when you hear that stat, you can start to think about, oh gosh, I think I understand why those organizations have grown so big. But still, getting a transparent review of the internal talent and the external managers is important. But you can't stop there, because you need to then take the next step and say, what's our asset allocation? What's our implementation model? What are the different things we are doing in order to achieve performance? Because the type of talent you need at an endowment model versus a Norway model versus a Canadian model is very different. And you have different identities of organization. So beyond that reconciliation of performance versus cost, you then need to think about strategy and asset allocation. And that's when you can begin to find appropriate comparables to benchmark. You can't just take a county pension plan in America and benchmark their talent against Ontario teachers. You need to at least find appropriate comparators. And that data doesn't exist today, to my knowledge. There's some opportunities to FOIA, Freedom of Information Act, this data out of pension funds, and begin to form data sets that allow you to say, hey, are we underpaying? Are we incentivizing correctly? Like, should we be paying endowment people that are picking fund managers the same as pension people in Canada that are picking deals? Maybe not. Actually, maybe the deal people are worth more than the endowment people. But today, you're going to find a lot of highly paid endowment people. Well, how did that happen? What was that transition? And I think we don't have answers to that because we don't have the data. And so then I go back to this charitable purpose question, which is like, but these are charitable organizations compounding their capital tax-free. So shouldn't we as a society at least ask for the data? I don't want to dictate what you do with the information because it's your board's duty to maximize risk-adjusted returns. But I'd like to know what you're paying, who you're paying, internal, external, and what the performance is. Boy, that was a long answer to a simple question, but it is a complex question.
And do you think that it's just really comparing within this country? So, for example, in Australia, they have made a very different choice, which is essentially to consolidate their superannuation, as you know, that as they call them, into very large funds. So, for those of our listeners who don't know, there used to be hundreds, thousands, I think, of funds in Australia, and now they're down to, I don't know, a couple dozen maybe at the
right.
for the whole country, right? And they're very large. They get very low fees because they're so large, and they attract very good talent. But but we've not chosen to do that in the United States. Some other places have where they've tried to consolidate. So is that kind of where you think that would lead to, or I see why you'd want to get the information.
Yeah.
Hypothesis with where does that take you?
Yeah, there's that Australian model is very interesting, in part because there is a regulation called RG 97 that obligates those plans to report on the entire cost basis of their performance. And then that pushes them to think deeply about the asset classes they want to go after and the implementation model that they pursue. They are very deliberate in their, call it, production function of performance. What are the inputs? What are the outputs? They're doing cost benefit analyses because they're going to have to report on them. If you go look at a standard US endowment, good luck finding that information. I mean, my alma mater at Princeton, like for a long time, the website had one email address. Now I think it's a little bit different now, but that was 8 years ago when I was doing all my research on sovereign funds. And I was like, but how are the endowments? Are they more transparent than these sovereign wealth funds I'm studying? And lo and behold, I realized, my gosh, the sovereign wealth funds are so much more transparent than the average American endowment. The Australians, they have RG 97, so they're incredibly transparent. And they have a regulator that has said, we're going to get you down to about 10 to 20 high-performing funds. And that has created an environment of transparency and competition, which does not exist in almost any institutional investor environment in the world. And so I would say the Australian super fund industry is the most interesting pension, retirement, super industry in the world today. They're doing the most interesting things. They're innovating on tech. They're innovating on talent. They're innovating on private equity, on all these different pieces. In part because there are these drivers. And I think what's interesting for me is I think that's the model we will end up with, which is a defined contribution model. It is a pooled model of professional investment. And so you end up with professional investors managing your money at scale, which then allows you to get the alignment of interests and drive it down. And yet it's a defined contribution plan. So it's not saddling some sponsor with, an unknown liability, which is a little bit daunting right now as you think about some of the medical breakthroughs that are coming right now. Like people could live well past 100 if we all have nanobots floating in our bloodstream, fixing our problems in real time. And that's why the defined benefit pension funds are, sadly, I mean, I want one, but they're sadly being pushed out because the longevity of us all is very hard to define.
And as you said, the Australian system has competition, which is which seems to work, right? I mean, I'm a big fan of the Australian system, as you could probably tell, but that combination of required savings plus competition plus scale plus good regulation that drives costs down. I mean, it's been quite a success story over the last, say, 25 years.
It's interesting because each system that you go and talk to, they're always, you want to say they're humble, but I think part of it is like they just don't know how bad it is elsewhere. So when you go talk to the Australians, they're like, we got so many problems. And you're like, you have no clue how good it is here. Like this competition for members, it gives you a license to delight your members, to invest in member services. This competition for survival that the regulator has put you under, it gives you permission to experiment and test and invest in new technologies to better manage portfolios and deliver products, to think about retirement in creative ways. Now, this has started to shift the other way, Sarah. I mean, that's the challenging part, is the regulator came through not long ago and created this test, the MySuper test, which has then pushed them all into this frame where, you know, if they fall below their peer group for I think it's 10 years, like, you know, the regulator can shut them down. And that, unfortunately, is starting to paralyze some of that innovation that I think was really differentiating that industry. So we'll see. I mean, you know, sometimes the regulator's wand gets waved and an industry completely changes. So fingers crossed that we can maintain that dynamism in Australia.
Well, let's hope that the Aussies don't kill the goose that laid the golden egg. But let's come back to technology, because you said they're innovating on technology. You've obviously been working a lot on this. You've said that, you know, the investment industry in general, technology hasn't really played out as well as perhaps in some other industries. You're sitting there in the engineering school at Stanford. You've got technology all around you. Tell us, you know, where is this going? If we have this conversation again in 2 or 3 or 4 or 5 years, you know, are these asset owners going to look really different with the technology, or is it kind of going to look like what we're familiar with, you know?
Oh my gosh. I think there's because I'm expecting most of your listeners are asset owners, and so I don't want to scare them. This isn't meant to be a spooky podcast. It's not Halloween. But the reality is they're going to look so different, Sarah. Like, for the first time, we are getting analytics that significantly move us beyond the simplicity of spreadsheets, which is really, until now, been what we have used to do complicated correlation. Now, occasionally you'll find investors that are using SQL or Python or some next level set of analytical tools, Stata, you know, all these different math computation toolkits. But that's at the margin. That's the 1%. The reality is most of this industry functions in PowerPoint, Word, and Excel. It's a Microsoft-dominated industry. And you see, as a researcher, some of the most elegant spreadsheets you can imagine. Liquidity models for entire pension funds with hundreds of supporting pages. I mean, it's like pushing the boundaries of Excel. And when you hit F9, it takes 20 minutes to recalculate. That's a fabulous advancement using, you know, an ancient technology. We've been running simple regressions in kind of spreadsheets and quotes since the Babylonians were doing it on cuneiform tablets 4,000 years ago, with the depth and flow of the Euphrates River being correlated to different commodity prices. It's like literally the same inferential capability that we see today in spreadsheets. But with the rise of AI, that inferential capability is shooting up. We are now extracting insights, in part because we're bringing in alternative data, which is another word, a safe word for ESG data. We're bringing in alternative data. We're cleaning it. We're overlaying those data sets on top of each other, and we're applying Gen AI, ML, all the fun letters to this data, and we're getting insights about our portfolio today and our trajectory into the future that we've never had before. So the way that I often describe this is we're entering this GPS moment in investing, where today we're kind of in this era of paper maps, where you're really proud if you know how to get from A to B. remember when we were growing up, we were sort of proud that we knew the direction somewhere. It's like a badge of honor. You're like, hey, I know a shortcut. Make a left at this light. The lights are all in time. Like, nobody offers shortcut advice anymore because you have the ultimate collective intelligence in your pocket telling you where police officers have set up speed traps and where roads are closed or accidents have happened. Why would I trust the shortcut dude when I could trust Google? And so that moment where we shifted from the paper map kind of spread out across your hood as you begin to play the game of figuring out where you are and where you're going, that world is the spreadsheet world in investing, where you're doing the data entry into the spreadsheet, you're building your own models, and you're trying to do discounted cash flow and comparables and all this fun stuff. We're about to enter the world of digital investing, where the data is clean. We have your GPS. We know where your portfolio is. We've established your goals, and those goals can be modeled and optimized. Just as you plugging in the destination you want to go, you're going to get a very smart set of indicators through your technology. Still going to need humans in the loop. You're still going to need to define your destination. You're going to need to clarify where you think you are. Who knows? But that's the vision. I think it's pretty exciting. There's also a whole series we could talk about the unlock of text through Gen AI, because most of the technology in this world has been about numerical data. And for the first time in my career, so probably ever, text, language has become a key area of analysis. And that's also very interesting for investors.
And even images. I mean, the unstructured,
images, yeah.
There's just so much of it too. So it's just, it doesn't have to be in a little square in the.
It doesn't, yeah, you don't need that highlighted square in your Excel spreadsheet anymore.
So
the wild one is quantified linguistics, just real quick. The quantified linguistic movement is fascinating to me because it's something like 93% of the regulated reporting in finance is text. And until the current Gen AI RAG, retrieval augmented generation movement hit with all of the natural language processing tools around it, we haven't been able to sort of take that as a data input at scale and analyze it. But you're going to start seeing new sentiment tools, new tools to de-bias your thinking, to spot all the different cognitive and behavioral biases in your own internal memos and call them out. You're going to be able to use deception science to flag paragraphs or pages that have deceptive markers. You're not saying people are lying, but you're saying, hey, according to the science, you are using deception here. And so let's talk about why. And so these are the exciting things for me. That's like, yeah, the organizations of the future, the pension fund of the future will inevitably feel quite different than the pension fund of today. But I still think we're going to have jobs, especially people who are trying to make sense of the outputs of this technology in order to guide investment portfolios.
So when you talk about this, to me, it sounds like we're talking about technology in sort of four different ways. One is looking at your whole portfolio. So it might be asset allocation, it might be where your biases, all of that. The second would be actually dealing with your managers. I'm not sure if that's what you meant on the deception technology, but
sure.
Really
or portfolio companies, but yeah.
But really being able to understand where perhaps a manager is adding alpha, where their biases are, and so on. You know, the third would be replacing those asset managers, because the AI can, and I know of some big asset owners that are testing that, and how can it manage money better than a portfolio man. And then the last, to your point, would be the portfolio companies themselves, which is really kind of thinking about where, you know, who's at the end of the day, who's really adding value, and ultimately, however you get there, that's where you want your money to be, is with those companies. So where do you think this is going to, or maybe it's none of those, but where do you think this is going to have the biggest impact? Is it how the whole portfolio is structured? Is it the asset management industry, and watch out? Is it, you know, where do you think it's going?
So there's a mass customization of portfolios coming, which is great for the institutional asset owner segment. I think the first thing that will go will be the use of generic expected return targets as a proxy for a goal. So when you hear pension funds say, oh, our return target is 6.9%, and we use that because some actuary somewhere has gone through all of our goals, aka liabilities, they've modeled them out, they've summed them all up across various scenarios, and they've created this number, which then is handed to the chief investment officer and the head of asset allocation, and then it's implemented as a strategy. And the goal is to meet that number. It's a kind of risk number, as in you better be taking enough risk to generate this, but it does more than that. It's almost becomes a goal. So I think as technology becomes much better at modeling goals, liabilities, why do we need that? Once we get rid of that, technology will become this engine of mass customization, because as you go into the capital base of every pension fund, you realize, hey, this liability set is much more mature than that liability set. So these two pension plans should be running quite differently. And yes, that might aggregate to a different expected return target. But if you can actually say, in this quarter, I need this cash ready, then you can start optimizing, oh, well, let's do this private credit manager for this specific cash flow. And then let's do that venture capital manager for this distant future cash flow 12 years from now. And maybe we'll do 3 more venture managers so we can get the perfect diversification for that cash outflow. Those are the types of optimizations I expect we'll see in, call it 3 to 5 years. I think what I'm describing is mass customization, but you could also think of it as portfolio fit. Like, we all have problems in our portfolio that we're looking for managers to solve. It could be that we're trying to manage inflation through an infrastructure investment. We're trying to get cash yield through, some private credit program. It looks like maybe we want capital appreciation through some. We need things in our portfolio, and the power of technology will be to deliver tailored advice to each plan. That is really exciting to me. The existing consulting model, not to throw consultants under the bus, but we'll just kind of back it towards them, is that their business model works when they can sell the same due diligence report multiple times to many asset owners. And it's just business logic, like doing a due diligence on a small manager with a niche product that you're going to sell that due diligence report one time doesn't make financial sense. But in the era of like really advanced analytics and technology and generative AI, we're going to be able to write you a report with no human in the loop, get you 95% of the way there. Then you're going to send somebody in to do, ODD and all the different stuff like that. But I think the ability to tailor portfolios and really fit opportunities to needs will be this exciting future that, it may even make capitalism function more effectively, right? Because now you've got a diverse set of agents out there pursuing different things, and you're not all chasing the same private equity manager and feeling, frankly, lucky to be given an allocation in a fund charging you 3 and 30.
Where my time horizon mind goes with that is to your point, which is that if you have very different liabilities, most people kind of manage to the average amount of time, that average return, but also the average time, which doesn't actually make a lot of sense once you get under.
No.
So being able to actually say my time horizon for this bucket of money may be very short. Maybe this is my, 3-month horizon money, and really separate that, both sort of mental accounting, but also really from the 30-year money. That would
I love it.
Very different portfolios than most people have today. Because right now it's kind of like, well, I got to sort of do well over the next, 1 to 3 years, and then we'll worry about the later years later, which doesn't always work so well.
Resonates so much with me to hear you say that. I mean, there's like a part of me that doesn't want to say this out loud, but I'll say it anyways, which is to say, look, at a 30-year time horizon, all of these things that people are so frustrated with right now, call it sustainability, climate, etc., these issues become commercially material. They could affect your ability to meet that cash flow. So as a long-term investor that is literally trying to help pension funds, but also help the world, right? To find the capital we need to avoid the threat, which is a threat I'm told is quite credible, of climate change. We're looking for this solution. If you go and you look at the pension funds that simply have a 6.7% expected return target over a 5-year period, they can get away with saying things like, look, I can't focus on that. The minute you convert that expected return target into a series of intermediate destinations that they have to deliver on as part of their fiduciary duty, you almost obligate them to say, hey, is there a chance climate change could affect our ability to pay these cash flows in 2045? And if the answer is yes, there is that chance, then aren't they bound to do something about it? At least measure it and monitor it. My philosophy in all these things is not to go into the CIO's office and say things like, here's what you got to do with this data, because I want everybody to make their own decisions. But I am ready to come in and say, why aren't you measuring the risks to that cash outflow in 2050? And I can remember when Canada Pension Plan would say they manage money on a 75-year horizon. Well, at year 75, like, you better be taking everything seriously. Rising oceans, hurricane increases, moving crop planting from north to south and south to north. Like, there's all kinds of issues you better be tracking at that 75-year time horizon.
It'd be fascinating to be the portfolio manager in charge of the 50-year portfolio or the 30-year like your job to worry about the next 25 years. It's to worry about only like 25 through 30, because then, the idea that you'd have a zero for a carbon price would be kind of ludicrous. And
totally. Shouldn't you be running scenarios? Let's say something a little bit heretical here. Why not? Because you're on a podcast. We use beliefs today as a proxy for these things. And I helped to design some of these beliefs for these asset owners, things like, markets are largely efficient, or sustainability, pays off in the long run, or illiquidity comes with a premium. Like, these are the types of beliefs that investors use, and they get matched up with assumptions and deals. So every time we do a deal, we write up a bunch of assumptions, and then we look at those assumptions and we say, are they contradicting any of our beliefs? And if the answer is no, then you kind of pursue the deal. These beliefs are written in the absence of quantitative data or proof. That's why we call them beliefs. They're beliefs because we say, gosh, we can't quite find unequivocal evidence to show this is correct. But there's a body of evidence that gives us comfort that we're right. Right? There's just enough there that we're comfortable. And so you go read the beliefs for all the big asset owners, they'll be slightly different, which is great. People have different beliefs. But I do think the power of technology, bringing it back to there, is to say, gosh, what are the scenarios in the future? What could happen? And in a world with generative AI, something called synthetic data, okay, which we're looking at now, and the ability to create millions of correlations, nonlinear correlations across asset classes, the types of projections you're going to be able to make far exceed what you can do with what's called Monte Carlo style modeling today. And that power will be at year 10, 30, 50, 100. You're going to have a much more rigorous set of possibilities where you might not need beliefs anymore, because you're saying, hey, what are the scenarios? What are the probabilities? And yes, there's always a black swan, a tail risk that could emerge. But even there, some of these tools that I'm seeing now coming out of Stanford are in the business of defining what black swans are even possible. And then you can create a black swan register and be like, hey, have we thought about these? Anyway, I'm going off now. Feel free to stop me.
I think it's terrific, because I think that one of the things that we've been thinking a lot about is both how will AI change the way investors invest, and you've always obviously thought a lot about that, but also this interaction between the investors and the companies. And I don't know if you've spent much time on that yet, but it is, if you think about the way investors right now traditionally interact with companies, there's some conference call and there are people there and some people listen and somebody writes it up and maybe that affects the stock price. And then maybe the company behaves differently because of something someone told them. It's a very analog process. And what I'd love to know, and I don't know if you have the crystal ball on this, but as we think about, how will that process totally change? And the challenge, I think, for me is that if you think about most quantitative investing, which of course is a little bit different than what you're talking about, it has gotten very short term, right? We're talking nanoseconds.
That's right. Yeah.
And so to me, the win is, how do you, as a long-term investor who has that benefit of time, use the technology, either, of course, in your own portfolio or with portfolio companies, to actually outperform and use your time to your advantage, and therefore have the time to take into account things like sustainability, and also have the time to give companies the time to grow or execute their strategy or whatever that is. So that's what I'd love to see happen, but I'm not sure we're quite there yet.
I just thought of something, which is, when you're calling into the insurance company and they ask you for your social security and your zip code, and then you arrive at the agent that your agent, I need to talk to an agent, whatever. You put that in and you arrive at the agent and they ask you the same question again. And you're like, wait, why didn't you use this information I plugged in? Why don't you have a dashboard about me? And I bring up that ridiculous story because I'm constantly frustrated with how we don't track and make use of the information in our society that we have at our fingertips. We sort of force this recollection. And as investors, we are constantly, and I mean asset owner investors, the pension funds with 400 managers, with 2,000 portfolio companies. We have all this information. It's as if each of these managers and portfolio companies have dialed in the social and the zip code. And then when we get on the phone with them, we ask them the generic questions again. When what we should be doing is managing that knowledge in a toolkit where I can say, hey, I know that you spoke with my colleague 18 months ago and you answered a question like this. How's that going? But that's going to require knowledge management systems that cut across organizations, that allow us not to have to be taking notes all the time. But, you see it all the time now on Zoom, these note takers on Hangouts, these note takers, this stuff is getting very elegant. And that is this opportunity for us not to just track and aggregate all the quantitative data, but all the qualitative data, which, if we're honest, is actually a huge amount of the work in this investment industry. Like, if you ask an investment committee what they're really focused on when they're doing a deal, it's often the references and the other investors in a syndicate. It's like people. So you really care about people. Yes, you want to make sure the margins are there. Yes, you want to make sure that the total addressable market fits the mandate. But you care about people. You care about the actual knowledge and community and networks. And a lot of that isn't tracked very well today. And I think as we build the systems to do that, you're going to be able to hold your managers and your portfolio companies accountable for things they say, which is a great start, right? Like, you said this, where are you now? And then obviously there's all the detection tools that you're going to have. Are they being deceptive? Are they being truthful? Are they biased? Is there something I should be paying attention to? And connecting data sets that are, differentiated. If somebody's talking about their climate footprint, wouldn't it be great to be able to pull in a data set that reveals their current carbon intensity of their production function from a different independent viewpoint? All of that creates transparency around these issues. And then you can really vote your proxies with confidence that what you're voting for is what's needed. And I think, to me, like, I agree with you. We really need that engagement to work. If you go and read, I've had the fortune or misfortune to read 38 different net zero plans of asset owners to understand how are they going to achieve their net zero portfolios. And a huge pillar in there is engagement. How are they going to help their existing portfolios move to a net zero commitment first and foremost, and then an implementation of that commitment? So,
wow, that may be a long-term aspirations, but I think it's going to happen faster than we think. And
I
also,
hope.
the people who do it well will be the ones who win in this game.
Don't you wonder, and this is a question for you now, don't you wonder if these 1,500 person pension funds will, I wonder, I'm not saying they are, will be at a disadvantage to those 45, 50 person pension plans? Because I think about this knowledge and the ability to aggregate it, extract insights. And I do wonder if in this little interim phase before the tech is dialed in, if being small and nimble, kind of like a Berkshire Hathaway, is a better approach than being, a 5,000 person organization like some of the big private equity funds of the world. Like, how do you actually make sense of 5,000 people's notes? We'll see.
Well, and I think, it's sort of the wisdom of crowds, right? You have to have 5,000. If you have 5,000 different views and 5,000 diverse views in some way, you're probably better off than, 40 of the same views.
That's a great point. Yeah, I take it back.
But if they have 5,000 of the same views, like if you have 5,000 people and they're all out of the same cookie cutter, then that wouldn't help you, right? That's got to be the worst of both worlds, because you've got the similar perspective, but the cost of coordination. So anyway, that's fascinating. And I think that as we think about this long-term trend with technology, the last question I'll have for you is,
okay,
my guess is that those well-resourced funds will be the ones that push this hardest, soonest, and the county plan from wherever will not. So are we going to have a situation where we just get more and more, daylight between the big, well-resourced, whether they're big or not, but the well-resourced, sophisticated funds and the smaller ones? And is that, back to our discussion about Australia, even more reason that model's just not going to work?
I know.
Or are we going to have, pension plan in a box on a computer, and you could do it beautifully with, a very small amount of money, in which case you would argue for real decentralization, and then you could be close to your participants and your beneficiaries and so on. So I don't know if this is going to lead to consolidation or decentralization in this whole space.
Yeah, I love that question. I've thought around it because I think I have wondered lately, these organizations I come across that used to brag, that you don't hear them bragging quite so much, about having internal Python engineers. I think they're feeling over their skis right now. I feel like they're looking at the toolkits that are emerging in industry, and they're wondering, what did we just spend $40 million building? It's about to get swallowed. And so there's a side of me, and I'm hedging here, right? Because this is the future, and a lot of it is up in the air. There's a side of me that thinks these medium and small plans that have managed to keep a white sheet of paper for their tech stack are in a great position right now to leapfrog those that have legacy systems. It's not legacy systems built on Cobalt, but it's definitely not legacy systems built on the modern AI stack. And so the big, well-resourced funds will have a challenge to shift from what they've just spent 10 years building to what the future is going to be, because it's not what they've just spent 10 years building. I can promise you that. But then again, they've just spent 10 years building it. So they understand why tech is needed, how to build dashboards, the power of knowing your portfolio GPS. And maybe they even have a culture of tech innovation where they've experimented. So I think some of this depends on what happens next. I think there was an old saying where, you look at the organizations and you short those organizations that don't have Python engineers on staff. I almost wonder if the opposite is true now. Like, what you need is like a really savvy procurer of technology that knows how to integrate it and build that custom deployment of technology. But the idea that public pension plans are going to build their own tech from the ground up, I think will be challenged. It will be under considerable speculation whether or not that's a wise path.
Right. All right. Well, I have taken a ton of your time, and I thank you so much for
It was so fun. It's over? Oh my gosh. That went by like in a second.
I can't believe it. I can't believe it. We'll have to continue the conversation offline. But thank you, Ashby. I really appreciate it. We are fellow travelers in this long-term space. And we really appreciate the work that you're doing. And we look forward to continuing to share and collaborate going forward.
I'm thrilled to do that. And I am also thrilled to take another walk and talk with you around the Stanford campus when you're next around. So that's a standing invitation. The last one was very fun.
I'll take you up on it. All right. Thank you.
That concludes another episode of Going Long with FCLT Global. We hope you enjoyed our conversation today and encourage you to continue exploring our resources and research at www.fcltglobal.org. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share with others who may find value in Going Long with FCLT Global.